Alan, good morning to you. Let's talk a little bit about what exactly you mean. Why is it now a stock picker's market with things at record highs?
Good morning, Dom. Yeah, the issue today is that the broad market is just very, very rich. We're trading at a forward PE that's in the 20s, and there's so much dispersion between the best and worst performers. It's really a time to look at individual names. Even in a market that is broadly overpriced, you can find value, but buying the indexes here is just a mistake.
So I mean, this is with all due respect, so to speak. I've heard this idea that we're going to see a rotation, value coming back into play for several years now, yet it still doesn't play out that way. It's all been about the market cap weighted indices, and it has been for the better part of the last decade. Why is it now, this record high, that makes you think that it's time to really get specific?
Well, I think that the market is just priced to perfection. There are so many things that present uncertainty, whether you talk about school openings, the election, the next round of stimulus. The market today is priced as if none of these things present any sort of downside. And so, again, it's because of the fact that we're now close to this record high that we hit in February. We'll probably hit it by next week. And, again, you've got to find value. And I don't mean it's going to be a sector rotation because, I think certain sectors that are low in valuation today will probably remain low in valuation today. I mean, even within this market, you've got to find value. Like, I still like technology stocks, and there's still value there.
So what stocks in particular do you like then? Because it seems to me as technology is one of the more richly valued sectors out there, not exactly a value one.
Yeah, no, what I mean when I say value is on a relative basis. Like, I look at, a Tesla, for example, which is trading at 1,000 times earnings, and of course people expect those earnings to jump. That's an example of one of those overpriced situations. Or even a Netflix, which is trading at, 100 times earnings. Not to say that it's a bad stock, but it makes a stock like Google stand out. Google is trading at 32 times earnings, and it's a cash machine. They've got high margins, and they're in every business you want to be in this environment.
All right, and just before we let you leave, really quickly, what would you stay away from right now?
I'd still stay away from the banks. I think the banks are really going to be hurt by not just commercial real estate exposure, but also low interest rates.